definitely not at a peak yet. We got a few more years to go.
So nobody wants to be left behind in this AI race.
Welcome to The Big Picture, our show that dives deep into the credit trends shaping our world. I'm your host, Paloma and Valentin, and today I'm here with Moody's analysts John Medina and Joshi to tackle a topic that has been hitting the headlines and igniting boardroom debate, and that is the digital disruption that's underway as artificial intelligence accelerates. It is causing a surge in data center build-out and huge spending by big tech firms and leading to concerns around a potential artificial intelligence bubble. So how will all of this play out in 2026? Let's find out. Thank you very much for joining us today.
Thanks for having us.
Over the past few years, we've witnessed a remarkable acceleration in the construction of data centers across the US, but also in China and all around the world. And the huge spending that's going to finance this build-out is causing some credit concerns. So let's get to the basics first. John, can you explain to us in layman's terms, what is fueling this growth? Is it really all AI?
Well, it's a combination. I will say sort of the start of it is something like this show, right? So the digitalization of the economy, right? All of our social media accounts, all of our searches, everything we've moved from paper to online services. We've all seen it in our careers. That has only continued. And as enterprises have kind of moved away from having their own data center in the basement or in their building, kind of moving into the cloud, a lot of companies that Raj covers, that even creates more demand. And then you then add AI on top of that, which is just the last couple of years, and that just accelerates everything, right? And so that just means that what we're looking at now is global energy consumption by data centers should double by 2028, 2030, which is a significant amount of growth in 4 to 5 years. Largest places, of course, being the US, about half of the global market, China, close second, Asia Pac, even Latin America, and Europe as well. So we're seeing that growth happen everywhere in order to supply the data computing capacity that all of these services need. But the biggest question, of course, is AI, right? That's the race towards something new, which is less known than some of the other services that are under demand today.
Would you say that we're reaching a peak? How is it going to pan out in 2026?
If I knew we were at a peak, we'd be in a different conversation. We are barely on the upswing. We're still moving up, right? On accelerated growth, double-digit growth. I mean, some parts of the world are very high double digits. Some are low double digits. We're seeing markets triple in size, double in size, within 2 or 3 years. For example, Atlanta wasn't even a market, 3 years ago. Now it's like the second largest market in the world, right? So we're seeing that quick movement happening. So you're basically seeing that continually everywhere. I think we're going to keep seeing this growth for a few more years. As I mentioned, that doubling of capacity. And it actually is for demand that's happening today. A lot of Raj's companies, what we see, have backlogs of customers that need that compute capacity. So a lot that's coming on today, this year and next year, a lot of that's for cloud services. Yes, we're talking about AI, but most of those are under construction. Yes, they're coming online slowly, but the biggest portion of capacity coming online today, it really is more for cloud and regular compute. So definitely not at a peak yet. We got a few more years to go.
Raj, you follow some of the world's biggest tech companies. Who's paying for all of this massive build-out?
So who's paying for it? Largely hyperscalers so far, large tech companies that have history of operating very large data centers. And we believe they'll continue to shoulder the bulk of AI investments. And these companies have big reasons to invest in AI capacity. They have substantial businesses that stand to benefit, and they also have the risk of disruption from AI. In addition to large technology companies, we have seen sovereigns supporting local AI initiatives. You've had very big projects in European Union, in China, in Middle East. So many countries are developing local AI initiatives. In addition to that, we also have a lot of venture capital funding AI companies. This is in billions of dollars. So you have those companies. So all of these participants, and as John mentioned, there's a lot of data center capacity being installed. So there's a lot of data center financing that is happening right now to support this AI build out.
So I just heard billions. How much are they really spending?
So our forecast is that capital expenditures by, let's say, 6 largest U.S. hyperscalers, Microsoft, Amazon's AWS, Alphabet, Meta, Oracle, and CoreWeave collectively will increase from 385 billion this year to around 530 billion or more next year. So just to give you context, we are almost at the third year anniversary of ChatGPT being introduced to the market. In the growth in capital expenditures from this cohort is going to be 4.5 times of the level of 2022 in 2026.
And this is all on data centers?
Since early 2023, what we have seen is that majority, if not all, of the spending, capital expenditures, is directed towards increasing AI capacity. And that's for competitive reasons, and also nobody wants to be left behind in this AI race.
How are they financing all of this spending?
So primarily, thus far, from internal resources like cash and free cash flow. For example, the 4 of the highest rated companies, Microsoft, Alphabet, Meta, and Amazon, collectively held about 350 billion of cash and short-term investments. And these companies generated around $500 billion in cash flow after paying dividends in the last 12 months. So clearly they have financial resources to make these large investments. In addition to that, we have seen in recent period, Amazon, Alphabet, Meta, and Oracle have raised new debt. And we also saw a recent transaction where Meta formed a joint venture with Blue Owl. And in that transaction, the joint venture is building out a large AI cluster for Meta, and that transaction was largely financed by the private credit market.
I think with all of the growth we're talking about and all this huge wave of construction that's happening, development capital is in demand, right? So private bank loans, project finance loans, equity, the REITs, anything in that development space. So private equity, private capital was mentioned. We're definitely seeing a lot of innovation there in terms of new players in the market. Like we're seeing new crypto miners that have powered land. We rated a couple of them, Wolf Compute and Cypher Compute, for example. They're in the market. There's others coming to the market. And it's not just the data centers. So like you have this long lease, with the company, you can go out and finance that. Great. But they also need the GPUs internally, right? Those are actually more expensive than the data center. And as we're seeing a longer life for those, you're actually potentially seeing financings for GPUs as well, which is newer, which we hadn't seen. And also I think the private credit being very interested in this space because they want that long-term cash flow that's contracted with a high-rated entity. They have long-term investments. That's kind of that good match that we'll see there. But the whole AI ecosystem that was being mentioned is also being invested in. So it's not just data centers, GPUs, servers. The power utilities need to build more power plants, more renewables, more gas plants, all of the transmission that needs to be built, the water utilities that need to be built. We wrote a piece on copper, right? Everyone needs copper for all of these assets as well. So the investment is really actually being spread across the entire market in multiple different areas because all of that is needed in order to produce these data centers.
And I've seen some reports with these, spaghetti-like diagrams, intertwined investments, commitments centered around, in most cases, OpenAI. There seems to be growing concern in the market that these could involve a lot of complexity, structural risk, overspending perhaps. What are these circular deals and why are they worrying investors so much?
No, Paloma, you're right. We have seen a number of these types of circular financing transactions in the AI ecosystem. And these arrangements certainly introduce credit risks in the AI ecosystem. That said, we also recognize that companies like OpenAI and Anthropic have very, very high growth rates, and they have a significant demand for compute capacity. We feel that these cash-rich companies are well positioned to support the development of nascent AI technologies. And this is not the first time something like this has happened. For example, several years ago, Intel, through its Intel Capital arm, made investments in companies like ASML, data center infrastructure software companies like VMware and MySQL to support and enhance its x86 platform. But of course, what we are seeing now is at a significantly larger scale.
What would you say are the key credit risks of these circular arrangements?
I think from our perspective, the key risks are, first of all, a lot of details and specifics around these commercial agreements are not made public. There have been very large announcements. For example, OpenAI has said that it is looking at approximately 1.4 trillion of commitments over the next 8 years. That's a very large amount of capital. And based on what OpenAI is a private company, based on what we know, it doesn't have committed source of funding. So risk obviously is concentration risk with OpenAI as a counterparty, for example. There is also risk that if demand were to weaken in the future, how will investors and outsiders be able to measure it? Because, as I said, a lot of contract details are not public.
And of course, it doesn't stop here.
It certainly doesn't stop here because we have seen many of these large hyperscalers. They are investors in these AI labs, which are also using their clouds primarily for development and internal research purposes. So, and they stand to benefit from revenue growth from these AI labs. So there is circularity. It's certainly we recognize, and we've had NVIDIA, for example, which has invested in CoreWeave, has guaranteed up to 6.3 billion of capacity if it remains unused. 6.3 billion at NVIDIA's scale, cash flow and cash levels, and its very low debt levels is not material. But it's just that appearance of these type of arrangements does concern us.
And how will OpenAI fund all of these engagements?
Well, we don't know. But I believe what is happening here is that OpenAI, first of all, is growing very fast. So it expects to generate its own internal cash flows. OpenAI has had multiple rounds of funding. The most recent rounds valued the company at around $500 billion. And I think company has said that they also could look at equity and debt issuance in the future to fund this growth. And we have seen sovereign initiatives and other things that possibly could be a source of capital. But of course, we don't know anything.
Okay, so this complexity, this circularity can cause the market to pause a little bit. But another worry must be obsolescence, right? So these data centers have very long lives, 25 years. They potentially have to replace the chips and the equipment in a much shorter time frame, maybe next 5 years, maybe even less. So, John, how would you react to this? Any comments?
Yeah, no, I mean, I think, well, before the sort of internal servers, I think it's interesting to hear about everything that Ross just said. I mean, 6 billion is not a big deal, 1.4 trillion. These are huge numbers. But I think the difference now versus past, cycles or build out cycles, because this is an infrastructure wave, right? It's not going to be this wave for 20 years. It's going to be a wave for a few years and we'll eventually reach some level of levelization. But now, as Raj was saying, there's these huge companies that are very cash flow positive, that have very strong ratings and strong balance sheets and lots of free cash flow that I think is different than past cycles. So I always remind people when we're looking at a project or a data center where OpenAI or Anthropic is the actual user, usually it's being supported by a Google or a Microsoft from a credit perspective. So from a credit perspective, you still see it all coming back to the high-rated companies, and that's important because when they're changing out servers or leasing out these long data centers, the developers of them need to know who's covering the capex, right? Who's paying for all of this on an ongoing basis. And so when they develop a new data center, build something new, usually it's built to suit, for what the hyperscaler needs. But others are co-location, multiple companies that are using it. They have to adapt and upgrade, right? They need to change the cooling system, change the power density, change some of the configurations. And I mean, honestly, there's so many different advancements just in the last few years. If you went to a data center 4 years ago and you go to one today, they look very different, right? And so you've seen that technology move very quickly. But at the same time, I hate to say developers are not stupid. They know what they're building. They know that if they're building in Arizona or southern Spain or parts of Asia, it's extremely hot and humid, and you need to manage that with a different type of cooling system than if you're in the Nordics or in Canada, or in Northern Asia, where you can just use natural cooling outside. So I think the developers are conscious of this. They're not trying to put themselves out at where they have to rebuild every 5 years. They know these servers are changing every 4 years or so internally, and they're working with their tenants, to accommodate that risk long term.
So looking again, 2026, what are the main credit risks that you're concerned about, John?
Yeah, no, 2026, it's interesting as what Raj was mentioning, some of the financing structures, and we're seeing new financing approaches, in this space, because right now we're in the development phase. We're in construction world. Everything needs development capital, right? And so that's where the innovation is happening. We mentioned the Meta Blue Owl deal. That was a new access for the private credit markets. We're going to see more of that. We saw two crypto miners, a couple of others that are now getting into the AI data center space because they have power, right? So they're using a different financing approach. So I think we're going to see a lot more unique financing approaches here. And as we talk about data centers, the buildings, the cooling, what's actually inside the GPUs, the servers, is a multiple of the cost of the facility. And as you mentioned, every 4 or 5 years, they keep changing them out. So they're putting in a significantly more investment. So as Raj said, a lot of that's been free cash flow. GPUs are now being seen as maybe having a longer life. And so now you're seeing financings associated potentially with GPUs, because maybe I can finance that rather than just having to pay for it in cash. And so we're seeing a lot of innovation there. But again, the credit risk still comes back to a credit-worthy counterparty. And that's where the unique financing structures are. And so we always, when we're looking at them, make sure that it still comes back to a credit-worthy counterparty. And we're still seeing that so far. And I say so far because bankers are very innovative, and we're going to see more. But with all of this growth that we talked about, this accelerated development, lots of construction, prices are going up. When you have this much demand, it's not like there's all of a sudden a lot more steel or a lot more electricians or a lot more other, computer manufacturers are online. They're trying to upscale to meet this demand, but they can't go as quickly. And so prices, frankly, have gone up pretty fast, frankly, for building a new data center. So that's another concern. And if you're going fast, speed to market is what you hear in this space. Speed to market, speed to market. Everyone needs to get online as soon as possible. Well, when you're rushing, there can be risk there, right? Maybe the quality isn't as high as you expected. Maybe when you commission that asset, it doesn't work as maybe the 15 others because you went twice as fast to build it, right? So we're already seeing projects delayed, which is actually unusual. Most data centers are early or on time. We're starting to see them be delayed now. Not all of them, but a handful of them. Labor and demand is becoming an issue. Pricing, again, is becoming an issue. So just normal, when you have a huge upswing in construction, you're going to see these risks. And so they're not all going to be perfect in the future. We're going to see potentially more problems. And same thing with the new operators that I mentioned, the crypto miners, others. New entrants don't have tons of experience like many of our other developers. We expect them to do a good job in performing what they're doing, but they really haven't proven themselves yet, right? So that's another sort of new risk. And lastly, when you look sort of globally, we look at a lot more of geopolitical risk when we get outside of the US a little bit. A lot of localization laws that are still happening in Asia, a lot of sustainability push in Europe, which is affecting development there. And then Latin America is actually moving the other way, where they're opening up just sort of the Redada law in Brazil, for example, changing some of their policies to encourage new development to come into the country. So you're seeing more development down there than they had in the last couple of years because they needed to change their tax laws in order to support this new growth.
Raj, anything to add? Credit risk, 26?
26, I would say a lot of things that John articulated actually pretty much overlap the technology industry also from the AI risk perspective. In addition to that, I think the lifeblood of the technology industry is innovation. It is the innovation that creates new markets, new products, but it is the same thing that also creates shorter product life cycles. So there's always that risk, something that we always look for. So where something new could come that could alter the rules of the market, that's something we look at. And I'm sure all of us have seen a lot, and this is a big debate in the market. Okay, our companies are making these large investments. Where are the return on AI investment? I think it's harder to prove. We have seen some early signs of it, and it certainly looks promising. A lot of companies that are making the biggest investments have history of are technologically very sophisticated. So we clearly will see, and these are subject to market mood swings too. Investors sometimes push back against a lot of spending, so there's always the risk that investor sentiment could tamp spending, and there will be a domino effect across the entire technology chain. But I think based on what we know, demand looks very, very solid for at least the next couple of years.
I thought that was a great conversation, and thanks to all of you for joining us. You can watch more episodes of our show on YouTube and all major platforms. And we will have more insights for you and more sector outlooks for 2026 on the Moody's website. We wish you all the best for the year ahead.
By downloading or listening to this podcast, you are agreeing to Moody's legal terms and conditions found at moodys.com/disclaimer, including that the information provided is not investment or financial advice, and that Moody's will not be liable for losses arising from your use of the information.